welcome to the February 2026 Empowered Senior Speakers Series. If you're joining us for the first time, just a warm welcome to you. We're really glad that you're here. And if you're a returning guest, thank you as well. We're glad to have you back and being part of our growing community. My name is Marian Gord, and I'm the host of this series. I created the Empowered Speaker Series way back in 2023. Not that old. No, it's gone by really, really quickly. I can't believe that we've done as many as we have. The series is to give older adults and their families reliable, timely, valuable information that relates to retired living and older practical information, and without sales pitches, and about the things that really matter as we age, and such as housing, care options, and planning ahead. So I'm glad that you're here. I hope you come back again. Professionally, I'm a real estate broker here in Burlington with Keller Williams Edge Realty, and I specialize in working with older adults, later in life moves, and estate sales. And those basically, it's through my experiences with my clients that I realized that there was a need for sessions like this, and clearly you're demonstrating that that is the case. I'd also like to acknowledge our educational partners who help us put these sessions together. They are all here because of their experience supporting older adults and families in our community, and they've agreed to take part in this session. Some of them right since the beginning, since June 2023, since we started, and some new faces this year. They also believe in the education first approach. No one here is here to sell you anything, but just keep in mind that should you have need for their services, we just ask that you give us some consideration. We'll come back to that, but before we go on, I'll just ask that you will let them introduce themselves.
Hello, my name is Jennifer Ferroni, and I'm an end-of-life doula with Compassionate Care Collaborators. Despite what the name says, we do a lot more than just provide non-medical assistance at the time of death. We are really here to support you and your loved ones from, right now when you are healthy and you just want to start thinking about what does a good death look like, to after the time of death and continuing to support loved ones as well. Thank you.
Hi, I'm Lori Meyer. I am a lifestyle consultant at Parkland Ancaster. We offer the full continuum of care from retirement apartments all the way to supportive lifestyles. And we have open houses every Wednesday, so I'm not there from 1 to 5 if anybody wants to just pop on in and take a look.
Hi there, I'm Jeanette Bach with Fluid Senior Transitions. I'm an elder care planner. I help in crisis situations, transitioning into retirement living, aging in place, and so much more. So come talk to me.
Hi, I'm Peter Curtis from Guelph. I'm a paralegal. I do medical law. Excuse me. So we help people with medical issues that may actually be disabilities, qualify for different government programs, including tax refunds.
Hello, I'm Lisa from Charwell. I'm representing both our Burlington locations, Martha's Landing, just around the corner, and Charwell Lakeshore. We have different levels of care, and I am happy to answer any questions you might have about that.
Good afternoon, everyone. I'm Dr. Sandra Belfry. I'm a clinical neuropsychologist and psychologist who's been working in the Burlington community for the last 20 years or so. For 15 years, I've had a healthy aging and dementia clinic at a private practice called Lifespan. And I diagnose dementias, and I work diagnosing seniors' mental health conditions and do treatment. Also, I have a new business where I provide psychoeducational workshops about reproductive health transitions for women and how it affects our brain health. And those are intergenerational, so they're meant to be offered to people from ages 20 through 100.
Hi there, I'm Carrie Abma, and I am an estate consultant offering estate solutions with care. So I have 13 years of experience in the estate industry, And last year I went out on my own to business for myself to provide similar services but in a more personalized way. I offer a variety of services, but because we're on a tight timeline, my most popular service is actually being able to act as someone's executor. So professional executor, we call it. I also can do POA for personal care and property. I offer support for executors who are doing the jobs themselves. I also do estate planning and educational workshops. So if you're interested in learning more, come up and chat. Thank you.
Good afternoon, everyone. My name is Kim Rutledge, and I am the Sales and Marketing Director for Vistamere Retirement Residence in South Oakville. And today I have some great information for you to give away to visit us at Vistamere on February 28th from 10 to 2 as we're hosting a Healthy Hearts Wellness Show. So we would love for you to join us between 10 and 2 on February 28th. Thank you.
Good afternoon, everyone. I am Judy Rickey. I'm the owner of Clutter Relief Services out of Hamilton, Ontario, of course, for the last 15 years. And we specialize in helping seniors with downsizing, right-sizing, clearing estates, and move management. So if you have any issues with clutter at all, please come talk to me. I love talking clutter.
Actually, who doesn't have them? Who doesn't have an issue with clutter?
Hello, I'm Elizabeth. I'm a registered nurse and clinical leader with Avita, which is part of Bayshore. We offer home care services, and our goal is to be your one-stop shop for aging in place. So we have your more traditional home care services like a PSW or a personal support worker that can help you around the home, help you with personal care. You'd always have a registered nurse like myself that would oversee the care and also support you with any health issues or concerns. And then aside from that, we also have things like snow removal, which is really helpful this time of year, lawn cutting, home maintenance, deep cleaning, specialized nursing services, respite. So it's one number to call and hopefully get whatever help you need. I'm also happy to chat about home care in general, and starting this month, I'll be doing blood pressure checks out in the hall over there before every session if anyone's interested.
Hello everybody, my name is Meredith. I'm a hearing instrument specialist just up around the corner on Maple Avenue at Hearing Well Matters. So if you have any concerns or questions about your ears, from wax removal, tinnitus, hearing tests, hearing aids, I am here for all your ear-related questions.
So I get to go last. I'm Sarah Sunnix from Smith's Funeral Home. I specialize in pre-planning funerals, getting information ahead, and then executor checklist, applying for CPP benefits and things like that. Thank you.
Wonderful, thanks very much, everybody. You have handouts and it's got everybody's contact information, a little bit of a summary of what they do, so there's no excuse for not knowing who to call. And we have Neela. I'll introduce Neela in just a few minutes. There's a couple of people that are not represented here today, but again, you can find their information on the sheets. Thanks again also to Lisa and Ida. They're always here helping me get settled, making sure that everybody gets in on time. We start on time. Thank you so much. Just wanted to let you know that last year was our first Empowered Senior Speaker Series Living Well Expo. So that is a sort of a trade show type event where you have an opportunity to meet not only us, but other senior service providers. If you were here last year, you know that it turned out to be a great event. You can come back because we will have new exhibitors this year. And so we'll have some returning exhibitors and new exhibitors, and we'll also have some presentations during the course of the day. So put that on your calendar. So that will be in April. It's going to take place basically at the same time that we're here on Wednesdays, but we'll have extended hours. It'll be from 11 a.m. to 3 p.m. So I'll be sending out more information about that as all the details are finalized, but just keep an eye out for that, please. And if you were here in November, Christine Brunson had a presentation on protecting your digital assets. And she had indicated that there would be a handout, and that hasn't been available up until last month. So if you were here in November and you want to get that handout, Edith's got them at the desk. You can pick that up on your way out. Just some housekeeping things here. Appreciate if you just make sure that your phones are on silent. If you have notepads and pens to be able to note down your questions, we'll take the question and answer period at the end. It's always best if we can just have those conversations later. Just want to make a note about the parking. So you may know that the parking at the art gallery has increased to $5. I've got nothing to do with that, unfortunately. So just ask that it is on the honor system. If you have parked at the back lot and you didn't pay on your way in, please do give them the $5 on your way out. Okay, so here we are here with Neela White. We're very fortunate to have her with us presenting today. You've all probably, if you've been here in the past, you know Neela, and she's actually had a couple presentations over the last couple of years. Today we're going to be talking about women and wealth and planning for longevity, security, and independence. So I'll just read her bio, because I'm going to ask that you pay attention. Neela is a very exceptionally qualified woman, and I'm proud to call her my friend, and I'm glad that she's here with us. Neela is a passionate advocate for open discussions and preparation for life-changing illnesses, helping families understand the financial and emotional burdens of long-term care. Her relatable style encourages families to plan for longevity and explore viable options. Drawing from her experience working in long-term care and as a caregiver for a decade, Neela offers empathetic financial guidance. She's also the partner and co-founder of BlueWing Advisory Group, Raymond James Limited, with over 29 years in the financial industry. She provides inclusive wealth management services as an aging specialist and senior portfolio manager. She holds degrees in psychology and gerontology and a certificate in thanatology. Additional certifications include certified professional consultant on aging, elder planning counselor, and certified executive advisor. She's also a certified patient navigator and certified dementia care provider with training in medical assistance in dying and death doula services. She's also completed her You First program and Last Aid. She's been an active speaker on caregiving, the cost of aging, healthcare navigation, and longevity planning. Neela participates in conferences, panels, media review, interviews, podcasts, and educational events. She's been featured in various industry publications and is a member and presenter for the Canadian Securities Institute and was a participant in their Financial Health Seniors Initiative. She's a frequent guest on BNN Bloomberg TV and a contributing author for The Wealth Professional. She's also an educational partner for the Empowered Senior Speaker Series. I'm happy to have her here with us presenting today, and which is obviously, as you know, programmed to providing information for youth. And more recently, Neela has joined as an educator for the Canadian Initiative for Elder Planning Studies. And in 2024, Neela was awarded the Woman of Distinction for Raymond James Canada. So, without question, we are in good hands today. So welcome, Neela.
Thank you for that introduction. And the one thing I'd say after reading that bio, I do not have all the answers, as has been pointed out to me. There may be two errors on the handout that I gave, so I'll let the marketing department verify their information. And if indeed there are errors, what I'll do is I'll bring the updated form in March. Okay, so just so you're aware of that. So again, thank you for that. The one thing I'd say for this discussion today, it is a discussion because everyone here is different. Everybody's risk tolerance is different, everybody's capacity to understand an investment and accept the risk associated with it is different, everybody's objective, time horizon, and the amount of capital that they're dealing with is different. But there is a commonality as females, and as anyone, so this isn't just for females, but as females, there is a commonality in what we deal with as women compared to what men deal with, so a slight difference is there. My presentation today, I'm taking from experience. My mom and dad were in the traditional father, mother, husband, wife role. Dad controlled all the finances and mom just took care of house, sorry, I shouldn't say that. She didn't just take care of house and home. She had the unrecognized, unpaid job of taking care of house, home, and her kids. When dad died, mom was 73 years old. And now suddenly she was on her own to take care of finances. In spite of me being a portfolio manager, they had their own autonomy and their own independence on managing their finances as they saw best for them. But when my when my father died, suddenly my mom was left alone with this big task that she never had an interest in, never really understood anyway, as long as the budget was there to take care of everything she needed to take care of. That suddenly she turned to me to rely on me to take care of and manage the money at the age of 73. So the stuff that I'm presenting to you has come from the personal experience of taking care of my mom personally before she died, and taking care of her money before she died to make sure that she did not run out of money. And that is a very, very big concern now with females. 50% of females over the age of 50 right now have financial insecurity. They're worried that they are gonna outlive their resources. So this is a growing concern, especially as we're dealing with the current economic situation across the border. So at the beginning of this, somebody had asked me, how am I doing now? A year ago, when it was February and when there was sort of this idea of tariffs coming in, I remember staring at the screen come March of 2025, literally like a deer in headlights. You'd get an announcement or a sound bite, market would rage higher, then the sound bite would be taken away, and the president would come out and say something else, and all of a sudden the market would decline rapidly within minutes. So when you think of investments and decision making and the emotionality behind it, we also need to brace ourselves and look past the noise, because look at what's happened since then. So many decisions have been reversed, so many decisions and comments made have been used as negotiation tactics, and we're seeing that happening right now with a certain bridge. And Kuzma. Oh, yeah. So we're starting off today with healthcare and long-term expenses. We read it, we've heard from all the professionals here today that one of the commonalities that's happening with us right now is that there's higher health costs for women. As you age and reach over the age of 70, the healthcare costs and the support needed tends to increase. But the little known fact is by the time you're reaching age 70, the healthcare costs increases by about 24%. And that's due to longer life expectancy, therefore needing more support in the later years. We also look at the long-term care financial burden. When we start thinking about items like aging in place, retirement homes, access to long-term care facilities, all of that comes with a budget necessary. And one of also the biggest fears is what happens, or what is my plan if I can't get into long-term care, even though I've satisfied the criterion of not being able to do 2 ADLs, I can't get in. The wait list right now in Ontario is 48,000 people long, and the average wait time, depending on where you are in crisis on the waiting list, can be, depending on the home you're waiting for in the area, can be anywhere from 6 months to 5 years. So when we tried to access long-term care for my mom, and she was eligible for long-term care, at the time CCAC, which is now Ontario Health at Home, told me that the wait list was 5 years, that I'm better off keeping her at home and being her caregiver. But what does that do to the caregiver? Yes, exactly. Rising healthcare inflation.
Sorry to interrupt, do they have a copy of that?
Of which one, sorry?
Yeah, I'll send it after.
Yeah. Sorry, rising healthcare inflation. This is one that's very interesting. So we're hearing right now that inflation has been tapering down. We're at 2.36% inflation. Hence, a couple of weeks ago, the Bank of Canada did not lower interest rates because they want to keep inflation anywhere between 2.4. So right in there, they're hoping that the number's going to continue to go down before they have to do anything with interest rates. But the interesting thing is inflation itself as a basket is 2.36, but if we look at the national healthcare expenditure, it is 4 to 7% higher than the CPI. So we're looking at whether inflation was ever an issue or not, which it became an issue in the last 4-ish years, healthcare has been continuously rising. And this is a very silent sort of rise. So you hear a lot in the news about shelter, food. We're all feeling that with food. Going out to restaurants now, especially the rise in alcohol prices. So we're seeing that because it makes headline news. because other industries are impacted by that. We really don't care a lot about how quickly is healthcare inflation rising, and what do seniors or anyone need to be aware of when they're budgeting for care or support. As everybody starts to age, including myself, your priority starts to change. You move from growth as a portfolio indicator to more preservation of capital, because it takes longer to recover from a loss, as well as income, because now you're approaching a time in your life where you're going to be reliant on fixed income. And fixed income, the interesting thing is fixed income does not rise, prices rise. So you need to find a balance between the matchup, okay? Managing inflation and expenses. When we take a look at that, the biggest issue that I see right now, especially when we're dealing with clients, is the aspect that what do we look at when we consider fixed income? So obviously there's CPP, there's OAS, there's any government or work pension that you had, so a defined benefit plan or a defined contribution plan. And that tends to be the base of your plan. But what we're seeing right now is that there has been a total decrease in defined benefit plans because they're so expensive for companies to offer. So the floor is slipping a little bit because the onus is being put on savers who will one day become retirees and start the accumulation to provide for themselves. And it's not a loud enough story that you need to provide for yourself as you're reaching retirement. Emergency funds. I can't stress this enough. We see this a lot in our practice as we have aging clients. It is really important to keep an emergency fund. My recommendation from what I've seen of expenses is anywhere between 6 and 18 months worth of expenses. And that tends to cover any financial shock that's going to occur. Right now in Canada, 25% of Canadians cannot withstand a financial shock of $500. So when we look at what happens if we have a hospitalization and then we're released home and there's no caregiver, Ontario Health at Home will provide some care, and then we look for outside firms to provide us with the support we need. Well, if it's not going to be covered by OHIP, we need to make sure that there's something within our financial planning that covers that budget. And the interesting things about financial plans is this, and again, I do have this the slant of aging and longevities. Financial plans are a reward for when we retire, and it's a great time in our lives. We don't have that work stress, and we can fulfill our bucket list and what we've always had a passion for. But what also happens is in that financial plan, you just have to make sure that there is a healthcare contingency as part of the plan. And I would recommend that healthcare contingency comes before legacy. So what we're seeing a lot of with parents, and I completely understand this because I'm a parent myself, is that parents will gift early to their adult children to help them with mortgages, to help with RESP funding for kids going to school, with their grandkids' first house and the newly created FHSA. All of those things without thinking, I'm 70, I'm 75, I'm 80. Everything is good right now. What happens at 85 when I need support? What happens to that money that I've already bequested or given away as part of my legacy? And you do enjoy watching your children enjoy it, absolutely. But for me, the concentration before legacy is self-sustainability. So we heard from Carrie that part of what she helps with is the POAs for property, for both property and care. It is a necessity in Canada, in Ontario, to update your wills, update your power of attorney, make sure you have a power of attorney for property and care, and make sure that everything is updated to reflect your current wishes. Still, in 2025, 50% of Canadians, with or without assets, it doesn't matter, you still have a value that you want somebody to recognize, do not have wills. 43% of Canadians do not have established power of attorneys for finance or for property. or for personal care. There was, in the research, there was no breakdown as far as the, is it more skewed one way or another? The thought is that it's more skewed to finances because that's what you think of more immediately, whereas you think of the whole aspect of medical decision-making on your behalf, they think that comes as an automatic to whoever's closest to you. Question just to ask, has anybody ever encountered where somebody's not had a power of attorney and you've been put in the very uncomfortable position of having to make a decision? I'm hoping, oh, if no one's answering, I'm hoping the answer is no, you've never had to do that, so good, I'm glad. It is a very horrible thing to have to make a moral or ethical decision based on somebody's values which you may not truly know. This stage of life is different. We all know this, I know this now. Longer life expectancy, living longer means planning for decades, not just years anymore. The average age of a woman, if they make it to 70 years old, is 85.2. And for a male, if they make it to 70, their average life expectancy now is 80.9. So we're looking at, if we're looking at retiring when we're 65, 70, we're looking at 20, 25, 30 years of retirement. And we know that what tends to happen is the last stage of retirement tends to be a little bit more requiring care, requiring support, which tends to be the most expensive years within your financial plan and within your asset pool. More fixed income. Again, we do a downshift into fixed income, so more things like high interest savings, money market, bonds, laddered bonds, GICs. It does provide stability in a portfolio because they tend to be slightly uncorrelated to the stock market, which, as we keep hearing day after day, it's reaching all-time highs in spite of global tension right now. But what we need to be conscious of is as we're allocating our fixed income in our portfolio, so that's our sort of safety portion, that it's matching inflation. Because if you allocate a whole portfolio to just bonds and it's not meeting inflation, are you making enough to still cover the adjustment in prices, in groceries, in rent, in fuel, medication? Less time to recover from a financial mistake. This is something very, very big that we coach clients on because a lot of clients will sometimes feel that they're missing out, but they don't understand the risk of wanting to participate. Has anybody heard the expression FOMO? Fear of missing out? Anybody be able to say when and around that started? What was the big thing that everybody was afraid of missing out on? Oh, housing's a good one. Housing's a good one. I'll give you a hint. They don't want to miss out on getting high. Cannabis. So that was one of the big ones. And then from cannabis, it sort of escalated into the next ones was sort of psychedelics. The next one into that was sort of Bitcoin and cryptocurrency. The next one into that was digital assets, so digital art. Imagine paying millions of dollars for a piece of digital art that you can see on your computer. Happened. That was a big craze. Then really in the meme stocks, and then in the last little bit, what have we been hearing a lot about? AI. So the difference a little bit with AI and what we're seeing right now is AI, the companies are coming in with numbers, with revenue. The pullback right now that we're seeing is because their forward guidance, so what they're saying for this year, for next year, is that their revenue is going to be coming off and they might have to lay off people. So AI is in an interesting position right now simply for the fact of it is making corporations, workplaces, assembly lines more efficient, but it's coming at a cost. So less recovery time. If you have a 20% drawdown in your account, it can take 2 to 4 years to make back that money. So when we talk about age and stage, do you have the timeline to accept any sort of drawdown? If there's a 50% drawdown in your portfolio, and I'm not making an assumption of what's in the portfolio, but just a drawdown in general, it can take, depending what the asset class is, anywhere from 8 to 20 years to make back the money. So when you think about accepting risk or wanting to move up the risk scale when you're investing, do you have the timeline that if there's a pullback, you'd be able to wait it out without impacting the amount of money that you can pull out of your accounts? So remember, with a RIF, there's a mandatory minimum every year. It really hurts a portfolio if there's a mandatory withdrawal amount and the portfolio is declining. And we're going to get to a strategy that we use that just helps sort of mitigate the volatility in any sort of account, actually. Protection, we want to preserve our nest egg, and rising care costs. You're going to see these themes repeated throughout because these are the most common themes right now that are affecting clients and their portfolios, and that what I believe that they do have to put protection in to make sure that they are not running out of money. Common realities for women 75 plus. So I'm using actually my mom as this example. For her, it was 73. Managing finances alone. The interesting thing is, for managing finances alone, 90% of women at some point in their life are going to be the sole financial decision maker within their family unit. So it could be as a matter of divorce, it could be because of widowhood, it could be because the person who typically made the financial investment decisions no longer has the cognitive capacity to do it anymore. Women tend to prefer stability over growth. Long term, this strategy works. This tends to be a bit of turtle in a hare. You'll get there because you're taking less risk. So you're losing less. You may not be growing as much as the neighbor next door that has the story about how they invested in Bitcoin and made a mint. Okay. Concerned about being a burden. I think all of us are worried about this, that you want your children to have their autonomous life. You don't want to be a burden to your children, which means that their self-sustainability has to be intact, and none of us know our end date. So it's not as easy as just being able to reverse engineer the math to figure out what the number exactly has to be. Everyone wants clarity, not complexity. So the biggest thing I find, and occasionally when I'm on BNN, and I find this a big thing, is that even when I'm listening to BNN sometimes, and I just listen to the language that they use, like I sit there thinking, I wonder what that really means. If I look at my portfolio, what does this mean? I think you want clear solutions. You want to be invested in stuff you understand, how it behaves. You want to understand the timeline of your investment, and it doesn't have to be anything complex. So role of investments. This is just a breakdown on sort of a bit of portfolio theory. Income first, you want to generate your cash flow. Stability over speculation. This is not the time to do speculation. But, and I'll get to it later, and this is not financial advice geared to anyone, this is just financial advice in general, because I don't know anybody's specific risk and objectives or anything about the audience, sort of thing. But you do want to have, unless you're 100% risk adverse, you do want to have a small portion of your portfolio in something that's growing, and that tends to be the equity market, that tends to be the stock market. That will help, even a small portion, like 10%, that helps with sustainability in the account, because that portion will be the portion that's most apt to keep up with inflation and surpass inflation over the long term. It doesn't have to be something speculative, it doesn't have to be aggressive, it can be just steady and what would be considered medium risk. At this point now, liquidity matters. You need to make sure that whatever you're investing in, one, doesn't have penalties if you need the funds immediately. You need to make sure that it's liquid, and what liquid means is that it's T+1 settlement. So if I sell something today, my money is accessible to me tomorrow. TSX moved to T+1, and that will be a global standard in Europe as well by 2027. We went from T+3. If I sold something now, I have to wait 3 days, unless I'm in a margin account, to access my funds. Now it's T+1. What you want to try to avoid is sometimes we have what's called an alternative investment. So that means it's uncorrelated market. It tends to be real property, a real asset. It tends to be outside of the market. Those have liquidity barriers. So even if you said right now I'm in desperate need for my money and you put in a sell, you may not get the money for a quarter, be 3 months. If any of you are familiar with the bridging story, bridging was an OM alternative. It wasn't a liquid alternative. They had to gate the structure so they're not releasing money. So it doesn't mean your investment has gone to zero, just means you don't have access to your investment, okay? Risk management. This is a time when you look at what is inflation, what is my cash need, and how do I put in the appropriate amount of risk that I'm willing to handle to make sure that I have my expenses covered and then maybe a little bit of growth afterwards. This is something actually I find very interesting. When we talk about being females, being women, we often think, you know, why is this still an issue? Why are we still receiving less? So the interesting thing, as of last year, and this always comes up on International Women's Day, March 8th, it's the same conversation that's always involved. Women of equal education in an equal job role in a corporation still receive 83 cents for every dollar that a man makes. And it's still that way right now. It's not closing. So we're looking at a gender pension gap. So what ends up happening is when we have less earnings, because we're getting paid less, we have less time in the industry, in the work industry, because we take care of moms, dads, children, babies. What tends to happen is we're contributing less, which means we actually start off when we're converting our incomes to RIFs, RSPs to a RIF, we're actually converting a lesser amount of money. Low earnings, time out of the workforce, underrepresentation in higher paying roles. That tends to also be because when you start having access to those higher paying roles, that might be when you're starting to make the decision of, I'm gonna have a family, I'm gonna take time out to raise my kids. That role passes, and it may not be offered again. Systematic bias in plan design. That was an interesting one. So what that is most defined contribution plans and defined benefit plans are based on contributions and time working. So if you're working less time because of job share, part-time work, because you're taking care of someone, anyone, what that means is you're putting less into the system. So there is a systematic bias still right now towards males. Women do have a longer life expectancy. At the time of conversion to a RIF, females tend to have a lower RSP balance to convert, higher withdrawal rates, impact of widowhood or divorce, lower risk tolerance. All of these factors, after years and years and years, has quite a large compounding effect, which leads in the end to a bit of a smaller pool. At a smaller pool, when expenses tend to rise because you also have that fixed income factor. Again, this is not specific investment advice. I keep saying that just because I want to make sure that this is just general information. Dividend-focused investing. One of the ways of achieving extra income in an account at a medium risk tends to be with dividend investing. And that would be whether it's through dividend-paying ETFs, exchange-traded funds, whether it's dividend-paying stocks, so that tends to be the banks, the pipelines, the utilities, the insurers, or dividend-paying mutual funds, okay? Bonds and GIC ladders. The benefit of putting bonds in GICs, unfortunately GICs right now are probably earning you about two-ish or less, and if it's a non-cashable, you're sort of stuck at the lower rate if interest rates start to go up. But it does provide stability in a portfolio, and the cash portion with a bond does provide you instant liquidity. Just be careful when you're buying GICs that you understand that there's a difference between locking in a GIC where it's not cashable until it matures, and a cashable GIC, which rates tend to be a little bit lower. So just double check stuff like that. Conservative balanced portfolios. That tends to be what we hear about with the 60-40 split, the 30-70 split. The bigger number tends to be the bond, and the fixed income portion tends to go up as we get older. We're not always in a great bond environment where this works. If we look at the last bull market, being in bonds, you would not have achieved the equity-like returns because we have been in a bull market. So I shouldn't say everything. So many things have just moved up regardless of what was happening, period, globally and even nationally within Canada. Income-oriented funds. Again, the big focus is on income-oriented funds. Sometimes under income-oriented funds, you may hear of products that are ROC, return on capital. So what that basically means is your capital is being returned to you. It lowers the cost base. It's tax efficient at the time, but because along the way it's lowering the cost that you paid for that product, one day when it's sold, there's going to be a larger capital gain because it's a lower tax base. If there's a higher capital gain, it's still a little bit tax efficient because capital gains are taxed at basically 25%. So 50% of a capital gain is taxable at your tax rate. This isn't a rule of thumb, but having 100% cash, unless you're 100% risk adverse, it tends not to be sustainable as we're getting fluctuations in inflation. So if you had $100 right now, there's 2.5% inflation. In 10 years, that product would cost more. But if you're only earning around 1.5, and inflation is 2.5, your real rate of return is 1%. The longevity risk increases, so we're needing to plan for longer years. The balance is required of having the emergency fund that's completely liquid. And the reason why I stress this is, I don't think any client ever wants to have a portfolio where there's no liquid portion, so that would be your cash, your high interest savings, your money market, that they don't have accessibility to. Because what happens is, if you're drawing down, having to sell to remove money, you're removing money in a declining market, in a declining account. So you never have that chance for any investment to repair itself because you don't have the time to. So you always want to have a liquid reserve. With our clients, we tend to do 2 years of living expenses, 2 years of RIF payments, 2 years of lift payments. That way, anything happens, we have time to let the portfolio repair itself. And the reason why we choose 2 is the number. When there's a bear market or when there's a correction, the average correction does not usually last more than 16 months. So hence the 2 years. The major risks that we see right now, and this is current with what we're seeing with our practice right now, is outliving money, inflation, healthcare costs, financial exploitation. This morning when I was driving here on the radio, I think the number is 27% of Canadians have been subject to fraud and exploitation. So we need to be very vigilant, and we'll come to that in a bit with trusted persons. Market volatility. On those big days when it's big red down days and I sit staring at my screen, all I think is, can I hear through the noise of this? So right now we're in a very interesting time globally. There's a lot of noise, there's a lot of shifting pieces, and I think what is necessary to do is just look past it and make sure that what you're holding is less susceptible to the volatility. So when I say stuff like that, I mean things like this. Every day we still need to eat, grocery stores. Every day we still need to pick up our medications, Shoppers Drug Mart, Rexall. Every day we still need to fill up with gas or plugging in for electricity. Any piece of technology we have that has a chip in it, it requires electricity, so that's infrastructure. So when we look at themes, or even when I think of senior housing, retirement homes, in-home access, who's the biggest maker of ramps, in-home elevators, chairlifts, stairlifts. So when I look at themes, I look, regardless if the rhetoric is happening outside of here, what still has a structural bias, and it tends to be the things we all need. This is just generally, this is for anybody here with sons, daughters, and grandchildren. Big keys: start early, set clear financial goals. Studies have shown that when people don't have clear financial goals, their plans tend not to come to fruition because they never worked towards something. They didn't understand what they were saving for, so they were unable to save. Stay invested. That's a big one. What tends to happen is you hear panic long enough, you start to feel panicky yourself, and you tend to sell at the bottom. And then you're hearing all the great news, and everything's at a high, and you think, I want to be in on that great news, and then you buy. So that's why it tends to be buy high, sell low, whereas what you want to do is buy low and sell high. And that's just an emotional bias when it comes to the emotions of investing. Have a long-term perspective. Understand your risk tolerance. If your estate, if your investments are complex or you have blended families that require a little more direction, don't hesitate to seek professional advice. I know a lot of times people are hesitant to go seek a professional because they don't know what it's going to cost. The one thing I can say is sometimes the cost of doing nothing is a bigger cost in the end. Invest consistently, diversify. Diversify is a huge, huge thing. Lots of people, when they see something moving up, so here would be a perfect example. In the last probably 2-3 months, gold and silver has been moving up consistently. Gold, because it tends to be a hedge. So in times of economic turmoil, especially with the newer information with possible escalation, in Iran, we're seeing gold moving up, and we've seen silver almost become parabolic. And what that was at the time, before the sell-off recently, was silver is actually a usable product. So you can make chips with it, EVs. So it was a huge usable product in short supply. Price went up parabolically. People were taking profits, and that's when you get the sell-off. But what you need to look at is, do we still need it? Are we still manufacturing? Right? Be mindful of taxes and inflation. Avoid emotional investing. So many times we get calls from clients wanting in on NVIDIA, wanting in on AI. We've heard on the radio, and I'm sure you guys have heard this as well, that there's been so much of a movement up on all of the Mag 7. And the big problem that we're having with that is they have been making expenditures to grow out their businesses in the tune of billions of dollars. What's happening right now is the investment world's wondering, you've made these expenditures for billions and billions of dollars. In 26, 27, 28, is the revenue coming back to you? And that's where it's starting to falter now because competition is big. Planning for healthcare costs. So in a previous presentation, I had given these numbers, but I just want to go over it. Home care. Costs can range anywhere from $25 to $50 for personal support, $60 to $100 for RNs. When we had to get in private care for my mom, and that would have been, she has passed away now, this year would be 7 years, we were able to negotiate at that point $20 an hour. So you can see how costs have gone up. Retirement residences can range anywhere from $4,000 to $12,000 a month depending on the residence, the location, the amenities, the support. Again, going back to my mom had fallen in our house and she had broken her neck and she became disabled. We took care of her in home. From CCAC, we received 3 hours a week. She required 8 to 12 hours a day. So we were spending about $11,500 a month on in-home care. And when she got accepted to a memory, so she was in her last 3 months of life, she's diagnosed with rapid onset dementia. When we were able to get her into a memory suite at a retirement home in Mississauga, we were spending $9,600 a month. Okay. So decisions that we make can be budget intensive. We need to be aware of that as opposed to unaware of that, thinking that we're able to do this and finding out we're not. Okay. And I think, and what I want to say as well, part of that discussion that has to happen is for people who are assuming that their children are part of the plan, have the discussion and make sure they want to be part of that plan and that they're going to be available. Okay, I think that's very important. We're in a environment now where children move around a lot. Children have competing pressures with their work life and their family life. and they may not be able to do this. Long-term care, as of July 2025, a basic room was $2,085 and a private room was $2,979. And bridging the gap, if your plan is, I'm going to get into long-term care because that bed has my name on it, it's just waiting for me. If you can't, what does your budget look like to support you in that time period to bridge before you can get 24/7 care? Okay. So again, as I mentioned before, this is going to be a constant repetition because really these are the components that are affecting right now portfolios the most from where I sit. Inflation, interest rate, geopolitical instability. That's a huge one. It's going to continue. Until we get some resolution with the stuff that's happening right now, the volatility will continue. I think, when we look at a day like today, Toronto stock market's down. Two things have happened. The whole bridge commentary yesterday, and then the president thinking that he might pull out of CUSMA or USMCA. Recession. If we have increase in the joblessness, we might see recession. Interestingly enough right now, and I'm wondering if there's going to be a data revision, the US came out with their numbers this morning, 130,000 new jobs. I don't know, I've been doing this 29 years, and what I find is that considering they were actually shut down for a couple days and data's delayed, I'm just kind of wondering if a revision number is going to come in a couple weeks. Because right now the market's quite euphoric, right? Because everything's prospering right now, as well as they're getting the big beautiful bill, they're getting their $2,000, so there's a bit of a wealth effect and it's going into the economy. How long is that going to last? Supply chain challenges, that's going to continue. So in 2025, a lot of what we saw is that companies' earnings weren't reflecting any of the supply challenges because they were jumping ahead before the tariffs came in to stockpile. The stockpiles are running out. So what we might see is in second quarter, third quarter, and fourth quarter of this year, the things that were built out at the cheaper price have already been sold. Now we're building out at higher prices. And that would be depending on what the company does and who the company is, passed down to the consumer or absorbed by the company. And it has a twofold effect. Absorbed by the company, their revenue goes down, their earnings go down. Absorbed by the consumer, it puts the punt on the consumer. So one of the things that we do with clients is called a cash wedge strategy. So remember I talked about having liquidity in your portfolio? So when you look at your portfolio, and this is regardless of size, you always need liquidity for an emergency, okay? It's good because it helps protect income when there's a ton of market volatility. You'd use your CPP and OAS and any pensions as the floor of your decision making, because that covers maybe basic expenses. Your income obviously varies with market withdrawal rates and portfolio size, and this strategy is most valuable when you're shifting from saving, so accumulation, to decumulation. The interesting thing is we've had lately a lot of clients who have retired in their 70s and actually start working part-time in what's called the gig economy, so doing odd jobs, consulting, that sort of thing. And the most frequent comment that I'm hearing right now is this, and I actually understand this really well. As we're younger, we're always encouraged to save, invest, and plan for that retirement date, so we're taught to save. We may not do a good job of it, but we're taught to save. The interesting that happens is when the portfolio shifts and it comes to decumulation, no one teaches us how to emotionally decumulate. You're no longer drawing a paycheck from your employment. It doesn't have a name on it. It doesn't go directly in your bank account. Your employment check now is your own personal savings. And this makes clients really, really nervous to see the decumulation. So 1 to 2 years of income held in liquid, low-risk cash for immediate needs, so that's your emergency, and your withdrawal. So if you're taking from your RIF right now, the advantage of that is, again, to reiterate this, if there's a market pullback, and we'll probably see a more volatile this year, last year the easier money was made, It prevents your advisor, or prevents yourself from having to sell in a declining market to remove cash for your payment. The next step, so you have your 2 years of cash wedge, then would be sort of the medium-term tranche. And in that, you would have stable, modest growth assets, and those are used to refill the wedge. So you always want to keep that wedge filled. So it would be things like bonds with a fixed maturity date, a bond ladder, GICs with a fixed maturity date. As soon as it matures, that goes into the cash wedge part. And from the longer term part, you replace the medium term part. So it's almost like stairs. Then the long-term growth portion, that's where the diversified investments that are aligned, and always remember this, aligned with your personal risk. Everybody understands risk really well as the market's going up and they're seeing great numbers. It is a much more difficult thing to understand and to digest when the market is coming off. So move 2 years in, allocate some assets to low volatility investments to continuously replenish that wedge. Invest the rest for longer term. Longer term tended to mean 5+ years. What we're seeing now is people are reacting, and 1 month, 2 months, 3 months seems long term. Okay, that's not long term. Long term is 5+, so it tends to be 2+ for the liquidity. Then anything from 3 to 4 is your medium, and that's what's used to replenish the wedge part. And then 4 or 5 years plus, those tend to be just longer duration assets. Benefits, it protects assets against sequence of return risk, ensures liquidity, stabilizes income because you don't have to sell to get the income, maintains diversification. The long-term outcome, again, stable and predictable income, long-term assets stay invested. They also have time to recover if there is a market pullback. Reduces emotional and financial stress during downturns. The biggest thing we see with clients is if they have enough of a liquid reserve, they do not react almost at all to the news they're hearing unless it actually has to do with war and Canada becoming the 51st state. Our clients were highly reactionary with that, and I understand that from a Canadian perspective. So when we also look at how we're investing, we want to look at the tax efficiency of what we're investing. So interest income, so that tends to be money market, interest savings accounts, high interest savings, bonds, produce interest. Interest is taxed the least efficiency. It's 100% taxed at your tax rate. Dividend income, so that tends to be dividends paid from corporations. Those are taxed more favorably. Capital gains, so only 50% of a capital gain is taxed at your tax rate. That is the most efficient income from a tax point of view. So when we look at structuring client accounts, what we tend to do is interest-bearing investments go into registered accounts, so the interest is 100% protected. Okay? Dividends go into non-registered accounts, and capital gains, non-registered or TFSA. The advantage of putting it in a TFSA is everything in a TFSA is tax sheltered. When you withdraw money, it is not considered taxable income, and it does not affect your OAS. Great strategy if you're trying to keep your OAS intact and not be clawed back is maybe taking less, if possible, from your RIF. There's obviously a minimum, same with a LIF. Supplementing with a TFSA. That way you can keep your OAS more intact. So this year the contribution limit is still $7,000. If you had never opened and contributed to a TFSA to year end, the maximum contribution that you could have put in is $109,000. Okay. Simple rules: 18 and a valid SIN number. If you over contribute, there's a 1% a month penalty. So something I've noticed, and this is the same with us at Raymond James and other institutions. Right now, the TFSA system is quite manual, so there's nothing that shuts off that says client has already contributed $7,000, next dollar in is going to have a penalty. And part of the problem, part of the reason, bigger part of why that is probably because Remember, when you withdraw from your TFSA, you can contribute the full amount that you withdrew in the following calendar year. It doesn't track it and offset it to know it, which is why you just need to make sure that you're checking My CRA account on CRA's website. However, just be careful about that site. It's not always most up to date, okay? For investments, with the TFSA, you can invest in almost anything. And the reason why I stress that is sometimes we've had clients come in and they sort of think by the name it's a tax-free savings account, that all you can put in there are things like money market, high interest savings, okay? You can pretty much invest in anything in a TFSA. The withdrawals create new contribution rooms, so if you took out $10,000 right now from your TFSA, next year you can contribute that $10,000 back plus whatever the new limit is for 2027, okay? Unused room carries forward indefinitely, so if you've never contributed and suddenly you sell your house and you have extra funds, great to top it up because you're topping it up. When you remove it one day, it's tax-free. Income does not affect TFSA room. It is not income dependent, unlike an RSP when you're investing. And no withdrawal restrictions. You can withdraw any amount at any time, okay? The one thing I'll caution, and this isn't, the one thing I'll caution because we've seen this happen, which is sort of interesting because I don't know, and I've never seen what is considered the rule of the nature of what the plan was supposed to be. We've had some clients who have made investments who have done really, really, really well. They bought, they sold, they bought, they sold in their TFSA. The TFSAs now are quite a sizable amount. They've gotten CRA letters saying that they're not following the spirit of the account. I can't, yeah. And I guess from my point of view, I guess, you know, maybe they're thinking you're using a registered account as a trading vehicle, but at the same time, it's your money, it's helping you in retirement. So that's just a teeny caveat. I can't find the rule written anywhere, but I know that a couple of our clients got the letters. Yeah. OAS clawbacks. So right now clawback starts at $93,454. Again, back to the whole TFSA and how it can be used a little bit more strategically. Because it's a tax-free withdrawal and it does not count as income, it would not be affecting any sort of OAS payment. Okay, so that's an advantage. Draw from the TFSAs first to keep net income clawback below the threshold to try to keep OAS in place as long as possible. We tend to use it with our clients in high income years. So in years when there's property sales, large RIF withdrawals, we use the TFSA funds to avoid pushing further clawback. In estate planning, TFSAs can be passed to a spouse as a successor holder. So it's rolled over without creating taxable income that could trigger a clawback on death. Oh, that's just it in bigger letters. Okay, this had come up on best practices for individuals living alone. And actually I had a conversation with someone here who is getting their stuff prepared. So I think the big thing is preparedness, okay? So even if you have all of your estate documents organized, somebody needs to know where they are, is the first thing. So designate trusted contacts, something you may have experienced if you've opened accounts recently, or it may be an adjunct form that your institution has sent out, and that's asking you for a trusted contact. That is now a CIRO requirement by our governing body. And what that's for is, let's say I had a client and I've been trying to get in touch with the client for weeks and weeks and weeks and weeks and weeks, and it's not like him that he doesn't call back. I have permission, once I talk to the branch manager, to contact that trusted contact to say, you know, I've been trying to get in touch with Mr. Smith for a month and he's not answering. Have you seen him lately? Is everything okay? Do not disclose financial information to that trusted person. We don't disclose anything about the account. It is simply almost a wellness check call. Or a situation like this. Client does answer the phone and they seem very nervous, very abrupt, very unlike themselves, or confused, or very much more forgetful. It allows us, again, once the branch manager is informed of the situation, we go and call the trusted contact to say, has anything been happening? No, does a person have a caregiver? Has something changed with their health that you've noticed? And part of the reason why we do that as well is just to help be a gatekeeper to abuse. Okay, so if suddenly the neighbor, or whoever the trusted contact is, says, you know, that there's a new person that's been coming over lately, but yet the person is in worsening form, we have to question that. Create a nice document. I hate that word, but anyway, that's a in case of emergency document. Okay, and what that is basically, it's something big and bright, all in one spot that has the location, the contact people of every important document in your life. Your wills, your power of attorney, your insurance policies, your investment accounts, any digital assets you have, all sorts of things like that. And I'm not going to say passwords, just because remember, passwords are the security to anything that has your personal data on it. So we'll get to that in a sec. So use a password manager. There's a couple on the market right now. One's called RoboForm and the other one's called Keeper. They're sort of interesting, not super expensive password storage managers where you can put your personal data and provide somebody, a trusted person only, with access. That way something happens, they have the passwords to get into your stuff. And you also have the chance to register your will. So KendaWillRegistry.org is a website where you can register your will, your power of attorney, your insurance contracts. Let somebody know that you've done it, because if they have to investigate, they can actually have access to the site and investigate if you're their trusted person or power of attorney or executor. This is technically what happens if something happens to you. And I'll tell you a story afterwards about how untechnical things become actually when somebody does pass away. If someone's found, people tend to be found if they've missed work, they've missed appointments, they're not returning the calls, mail's building up, a neighbor triggers some sort of concern that they haven't seen you in ages, yet they saw you every morning at the coffee shop. Sometimes landlords, building managers, or medical providers may raise an alarm because you've missed a couple of appointments. If a death is discovered, the police secure the home and identify the individual. The coroner or the medical examiner is called to take over to make sure that it was an expected death and that there was nothing foul about what happened. Authorities search for the family, the executor, or the contacts. If none found, the public guardian steps in. Documents are located. Authorities perform a basic search. And I can't remember the number, the actual physical number of assets that go unclaimed, that go to the government. It was shocking to me. Executor found and identified. Once the will has been ascertained and their identity has been ascertained, they can access the bank, insurance, tax records, or statements. Without a will, the estate is intestate, and that tends to be a huge problem. And if no contact exists, then it's public guardian and trustee that takes place. Assets are dispersed if they can find beneficiaries. If they can't find the beneficiaries, it goes to government registries and sits there. And there's billions of dollars sitting there from simple things like bank accounts outside of investment accounts. So that's technically what happens. The untechnical part I was going to say is when my mom passed away, it was an expected death. When she died at the retirement home that she was at, I'm not sure why they did this. The head nurse called the police. The police showed up while we're sitting with mom's body in her room. After the police showed up, they had to call the coroner because that's procedure. The coroner asked if it was an expected death, and I said yes, it was documented as well. Once they released her, after about an hour and 45 minutes, we were finally allowed to call the funeral home to take her away. All of that could have been avoided because it was an expected death. So things don't go always the way we plan, but the best thing that we can do is try to plan so that we know that we've done everything that we need to do to at least try to foolproof the process. That's it. Thank you.
So you commented, being the long-term care home, it was an expected death.
Issues in a retirement home, yes.
But
Retirement.
what could have been done to make sure that didn't go through police and then coroner?
So in the end, when the police all left, before the police left and before the coroner left, they called in the head nurse. And what had ended up happening was, I guess the head nurse was new, had never seen a death occur in room. Death 911. It was a shame because I was prepared that mom was gonna die, my sister wasn't. Yeah. So there we are, just the not knowing, right? Yeah.
Is there a restriction of who you can name in receiving your tax-free savings account?
No, so you can assign anyone as beneficiary to your TFSA. If you assign a spouse or a common law partner, it tends to be more tax efficient because there's a rollover. If you assign a child, a friend or anything, it is deemed disposed if they get it immediately. So let's say the TFSA is worth $100,000 and they dispose of it immediately and they get it immediately, there's no tax payable. If it's disposed but they're not able to release it immediately, and let's say the value went up to $105,000, that $5,000 is taxable to the beneficiary.
When somebody dies at home, does a coroner always have to be called?
I honestly don't know. Does anybody else know that one?
I do.
Or Sarah?
So actually, things have actually just changed this month. So you guys are all going to be the first ones knowing. So if it's an expected death or palliative care, you have an on-call nurse who will come in and pronounce the death. When that on-call nurse comes, then the funeral home can come at that time. If it's an unexpected death, so what that means is, regardless of your age, you go to sleep and you don't wake up, okay? So, and we weren't expecting that to happen. Then it is a 911 call. The police do come to the home or the paramedic. There's now this paramedic that can come. They do a small investigation, and all that means is they just want to make sure no one's broken into the home, no one's pushed you down the stairs. They just want to make sure it was a natural death. They then call the coroner. The coroner doesn't come to the home. They make a phone call to the coroner, and then the coroner can then release the body either to the funeral home or the body then goes to the coroner's office. So that's kind of what happens.
So they rely on the paramedics.
They rely on the paramedics or the police. The police now don't have to stay at the house until the funeral home comes. So this is something that's new this month, that we might get a phone call from the police saying, okay, the body's released, we're leaving. So the family might be alone with that person until we come. Yeah, so even more important to know who to call when it happens. So that's unexpected death versus expected death. So what she was talking about was expected death, so there shouldn't have been a 911 call. Anyways, back to Back to Neela.
Now, you mentioned that you need to register your will and powers of attorney with the Canada Will
You don't,
Registry.
you don't need to, but if you want to, you can. That is not a mandatory thing, that's an optional thing if you think, you know, I want there to be outside of my home a central place where an executor can look for my stuff or a trusted person, but no, it is not mandatory.
Okay, I thought maybe the lawyer would be doing that.
So, yes, you can go to your lawyer because they tend to keep your will, which becomes official when you die. They tend to keep that in a vault. But sometimes what tends to happen is this: they know somebody has a will, they have no idea who the lawyer is or the law firm. So if you put it in the central registry, it doesn't matter that they can't find Joe Blow, or maybe Joe Blow has gone out of business, or retired and didn't pass on the business. Things go to a different law office. So you can do that if you just sort of want the extra safety. Or definitely if you have a will made, make sure whoever your executor is, one, knows they're the executor. We've had instances where kids have not found out that they're the executor until the person died in ICU, okay? Make sure that they know who the lawyer was, where your draft copy of the will is, and who to contact in the event that you pass away.
What if the lawyer died already? I had that case.
If the lawyer has died already, I guess if it was a sudden death, what we've seen, so again, this is just what we've seen. What we've seen is for any of the lawyers that our clients are dealing with or that we refer out to, if they're if they are diagnosed with something terminal, they're unwell, or they're approaching retirement, what tends to happen is they already have a junior lawyer already in their firm working as an associate or a partner. It just rolls to that person and they leave or they've passed away. So it should still be at that same law firm as long as the person had a succession plan.
I have a question about TFSA. You mentioned that and I missed somehow. How to use TFSA to make sure that the clawback for all OAS is below the limit?
Okay, so let's say the threshold to start clawing back 15 cents on a dollar starts at 93,000 and change. So what you'd end up doing is, if you're close within your income, so with your RIF, any pension, any LIF, let's say you're close but you still need extra money, you'd want to take it out of your TFSA because it's not considered income, so you're not pushed past that threshold to get the clawback.
Hi, I have a question back to the wills. I'm fairly new to Ontario, and they do things a bit different than where I came from. I got a new will when I moved to Ontario, but my lawyers gave me the will and said, you're the one that has the copy. You don't have a copy of the will. Which sort of concerns me, because if my house burnt down, there'd be no will.
Right.
So, and they said, don't put it in the bank because your executor can't get at it because it says in the will that they're the executor.
Yeah, it's a hassle to get into somebody's safety deposit
So I
box.
thought maybe, would it help to sort of go to a notary and have the will notarized?
Yeah, so from a brokerage perspective, so understand, for anything I've said, I'm not an accountant, I'm not a lawyer, I deal more with investments, but from my experience then, when something happens to a client and we require documentation from the executor in order to settle and disperse the estate, we will almost always ask for a notarized copy of a will, if not the original. So having a notarized copy is a great idea. And it's also the sort of thing of what we tend to ask our clients for is if they have a will, well, one, we very much stress that we're not fond of clients that don't have a will because it presents all sorts of challenges when it comes to money. But we'll ask our clients for a copy of their will and a copy of their POA. That way, if something suddenly happens and we've never met the executor, we know who's named executor, so we're not caught off guard. And also same thing with the POA for finance. We do encourage our clients to bring them in for a meeting, just so we're familiar, so you can also give it to your advisor for safekeeping. And sorry, one of the other things I was gonna mention just about being solo, being on your own, and what happens or how does somebody know. So the one thing I would recommend to everyone is wellness checks with friends, family, community, your advisor, someone, just to have wellness checks once a week on a certain day, just to make sure everything's okay. It's great from a social connection point of view, but it's also important just that somebody knows you're doing okay. Okay, sorry, I forgot to mention. Yes, ma'am.
Will we be able to access your presentation online? I will send it out.
Yeah, Marion will send it out.
Oh, okay, thank you.
Yeah. Yes.
I wanted to ask about the trusted person. If you're in a situation where nobody's speaking for you, where do you keep that trusted person's information and how do they locate in the note, even though that it's there?
Because it's on the application form. So one of two things happened. When it was coming in as a best practice, which was sort of 2024, there was an actual form that your advisor would have sent out asking you to complete the trusted contacts. So that would be the name, the phone number, an email address, and sort of the relationship. They're a neighbor, they're a family member, who are they? Because we want to make sure they're also not the potential abuser. What ended up happening now with new paperwork, because now this is mandated by CIRO that we have to ask. You can refuse. You don't have to fill it out. And sometimes we have clients don't fill it out just because they're very concerned about somebody knowing or getting up in their business. So you can refuse, but we encourage clients to do it. It's actually on the new client application form, trusted contact, name, phone number, email address, relationship. And then it's also our duty when the client sends it in to ask who that person is and to ask familiarity. So when we see it, like if I see it and it ends up being maybe a neighbor, especially if they're in an apartment or a condo, do you go to coffee? Do you go to a movie? Like, how do you know this person? Yes, that's right.
That just is with your company. What if you don't have your company?
If you have an investment account somewhere, this is a requirement now.
Oh, okay.
Yes.
Sorry.
Yeah, so this is the extent that we take it to, with also finding out what is your relationship, that you're not, hey, can I put you down as a trusted contact? I know nothing about you, and then we're talking to this person who knows nothing about you. So, yes. Oh.
I remember my investment advisor asking for the trusted contacts, and is your bank supposed to ask you too, where you keep your bank accounts?
I'm not sure, but I know my bank has not, and I bank with TD.
I'm RBC, and I don't know.
I asked TD about that.
Oh.
I don't have any investments with TD, but I don't have any investments with TD, but I have had my bank account with them for years, and I asked, would they like to have that information, and they said no. It's only for investments.
I don't know, when I think about it, cash is an investment, just a different asset class, but, right? Somebody here?
I had a question really about international executors.
Okay, yes.
So if your main executor is halfway around the world or right across the world, is there any kind of advice that you have for that?
And I don't want to sound as glib as I'm going to sound, don't do it. It is so complicated when there's a cross-border or international executor for all sorts of reasons, including having to put up bonds just because you're not the executor here. In a situation like that, what we would recommend to a client is there anyone else in the country that you trust? And it also could be this sort of thing, that if you're dealing with a trust company, they can be co-executor, so they're the feet on the ground in the country that you died in, and that you're residing in, and that your will was domiciled in, and that person can just be more of somebody said conduit, yes. But I would say do not do it, especially because now estate rules are becoming so much more complicated. It's really difficult. Like it's so difficult.
Okay.
Yeah.
So in terms of having like almost a backup, so either a trust company or another individual do that backup.
Who you trust. A person who you trust, okay?
Okay, wonderful.
I think I have PTSD. I think I'm scarred by just stories you sort of hear on just bad things. So just make sure whoever you choose for anything that you're choosing, just please always make sure that their values are aligned with yours, their intentions are in line with yours. Okay,
I'll just mention I bank at the Bank of Nova Scotia, and if you have an executor or a beneficiary, the trusted person is on your account profile.
Okay.
So if you want to check with your bank, just to make sure, because it is the law, they will have it on your bank.
See, and it could be maybe they didn't, maybe from a bank perspective, they don't because investment firms, brokerages were governed by CIRO. The bank isn't, but the brokerage part of a bank is. Maybe that could be the reason why. But even then, like when you think of it simply, the amount of scams that have happened, like when you transfer money to a client's account, then suddenly you see multiple wires, and then you find out that somebody was in love with them in another country, and all that. It's the whole protectionism, and I believe that whether it's a bank account, it's still a cash asset. Whether it's cash sitting in an investment account, it's still a cash asset. As my personal opinion only. Yes.
Need a mic. I wore my flats today.
You were mentioning earlier about beneficiaries. So if I die, is it more beneficial to leave my money to beneficiaries like different kids and friends and all that, rather than the estate? Would it be tax-free? And what did you mean by a delay in, why would it be delayed in giving them $100,000?
Okay, so let's talk about the delay first. From a brokerage level, what happens is as soon as we hear that a client has died, the first thing that happens is the account gets restricted. You can release money to cover funeral and lawyer. So the account's restricted. You can't buy anything, you can't sell anything. What happens next is we are asking the person's died. The person who usually calls us tends to be the kid or the executor or both. We then ask them for a copy of either the probated will, depending on the size of the estate, or a notarized copy of the will. We ask them for a death certificate. We ask them for their own verification, so they have to complete forms about themselves personally. They have to send in their ID. That usually tends to take weeks, let alone if the will has to go through probate, that's months to years, and let alone if you don't know where the will is, but you know there is one, because it still has to be notarized. So the idea of, I know somebody's died, I know their beneficiaries was son and daughter A, B, and C, it doesn't automatically just go through. The last will has to be verified. And as far as beneficiary goes, we've seen it both ways. We've seen clients who have left everything to their estate. That way there's no fighting. Okay, it goes through probate, taxes are paid, here's the residual, here's the disbursement. We've also had clients who intentionally have left kids as beneficiaries on their RIFs or TFSAs because it'll go to them, it'll bypass probate. Okay.
So is that just TFSA or anything?
No, so remember, if you have a non-registered account and you die, the date of death is considered the date of deemed disposition. So whatever your adjusted cost base is, so let's say your portfolio, the invested capital is $500,000, and the day you die it's $1 million. Your deemed disposition is $500,000, so that's tax payable. If you do not put, so a couple things with a RIF. If you put a spouse, it's a tax-free rollover, spouse or a common law partner. Anyone else, the day you die, so you can still put a beneficiary on, but the day you die, it is considered an immediate deemed disposition, and the whole thing is taxable at your tax rate. So there was a fellow who asked a question about last spouse to die, how do you minimize taxes left over on a RIF, and how do you plan? So a couple things. When a spouse dies and their RIF rolls over to another spouse, depending on the size of the RIF and the size of their other assets, we'll tend to encourage them to draw down the RIF first and faster. If they don't, yes, the taxes are payable because obviously it is taxes income. The minimum is the taxes source, but everything else. Yes, you have taxes, but you're paying it along the way and you're spreading it out over years. If you do not need all the money that you're withdrawing from your RIF, your other option is then make sure your TFSA is topped up so it still stays growing somewhere tax-free, or put it in a non-registered account. The other thing that we're seeing clients do more now, which is interesting, is we're seeing a lot of clients to avoid tax to their estate, gifting it, like making the beneficiary a charity. That's called, the new thing is called charitable giving. So what happens is you have a portfolio and you put the Cancer Society as your beneficiary. The full value goes to them. You get a tax receipt for the full value, so it offsets tax. So again, when we talk about legacy and self-sustainability, in my opinion, self-sustainability first, then anything after is legacy. So that's to whoever you hold near and dear, whoever you value, and charitable giving back. It's complicated. Because what ends up happening is, again, I'm not an accountant, so I'm only talking from what we've seen happen with clients. Even sometimes when you joint assets, so you know how parents or a parent will joint their assets with their kids? We make sure that there's an accompanying letter and it's stated that this is only for estate planning purposes. But keep in mind, it doesn't mean CRA recognizes that. We're just doing that so there's some protection on the account that Johnny's calling for dad's money because he has equal access on a joint with rights of survivorship account. We're going to say, no, Johnny, you're not going to get the money because dad did it for estate planning purposes only. Or we notify dad, hey dad, your kid just called wanting $50,000. So the gifting is tricky, and again, you'd want to check definitely with your accountant. It always becomes a little with CRA.
Well, thank you very much, Neela. That was all very insightful. One of the things you said right close to the beginning was healthcare contingency should come before planning, legacy planning. That really stuck out with me because actually living with my parents who were elderly, they always wanted to leave something for us when they really needed the money for themselves, to take care of themselves, so a lesson learned. I have this slide here all the time. I think you heard that word plan probably 50 times in your presentation. It's something, doesn't matter who's talking, it's always the same message. This session is being videotaped and it will be on my speaker series website. I will send out an email to you as well with a link to that, probably in another week or so, but they're all there. All the sessions from the beginning of time, all but a couple, are on that. It's on the past events page of the speaker series website. And just a reminder that the expo will be on April the 8th, so we'll have a regular session next month in March, and then April 8th will be a little bit of a switch. Thanks again to all our educational partners. Couldn't do this without you. And again, please do make use of their services when you have an opportunity. The next session is Wednesday, March the 8th. Another special treat. Her name is Dr. Laura Schutz, and it's Safety Net for Aging in Place, Planning Ahead to Stay Independent. Its messaging is very much the same. This is going to take more of a healthcare perspective. And once again, thank you very much. Have a good afternoon.